Well, good morning and welcome back to the Broadcast Retirement Network's BRN Sunday podcast. I'm Jeff Snyder, your host, and I'm going to be joined today by members of the media, academia, and financial services as we go around the globe to analyze all the issues in retirement markets, technology, personal finance, and more. It's been an extremely busy week. We're going to break it down. We've got a very special guest this week. Devin McCarthy from the NASDAQ is going to be joining us. So sit back, relax, and enjoy this episode of the BRN Sunday podcast. Let's kick things off with a look at the latest social media trends. Joining me on the line, he is the Senior Financial Services Editor for LinkedIn. He's also the editor of the This Week in Finance newsletter, which you can find on the LinkedIn platform. He is Devin Banerjee. Hey, Devin, how are you?
I'm doing pretty well, Jeff. How are you?
I'm doing well, and you're doing double duty as you always do on a Friday. You're on the network this morning, and now you're on the podcast, which we record on Fridays, but we play on Sunday. So we'd like to disclose we're a full transparency operation here. So, we recorded your segment on Wednesday. But anyway, Devin, it's always a pleasure chatting with you. Great segment this week on the show, really meaningful to me in a lot of different ways. Thanks for doing that. So what's top of mind? Lots going on. I saw the job numbers this morning. I got to think that there's a lot trending in the in your world.
And right now on Friday, first Friday of the month, meaning it is the jobs report, and that is what's trending. It's a really stunning turnaround. Everyone is scratching their heads at this. So the unemployment rate for May came in at 13.3%. Of course, on an absolute basis, not a great number, but that is a drop from 14.7% in April. It's also way ahead of what expectations were, which on a consensus basis were about 19% for the unemployment rate. So, as I said, people scratching their heads at this, but look, I mean, we're just looking at the data, and no one knows exactly what the future holds. But if this trend continues, then it appears things have really bottomed out, and so that people are just discussing that all angles of that on the platform right now, as well as the market reaction. As we record this, the S&P is up 3% on the day.
Wow.
Dow's up almost 4% right now. And so there's also a lot of conversation and explanation going on around just how the markets are reacting against the backdrop of a lot of social unrest this week. And of course, the underlying economic figures, while rebounding, are still, as I said, on an absolute basis, not great.
Yeah.
So a lot of explainers out there. I would recommend you look at James McIntosh from the Wall Street Journal. We're featuring right now at the top of the feed with a story about why Mr. Market ignores a world in turmoil. Ed Yardeni, who's one of my favorite people to follow on LinkedIn, says, look, this is a ray of sunshine, and he says we should all be heartened. It's better than seeing investors afraid and selling stocks. That would be a bet that we cannot solve our problems, and yes, we do have problems. And that would be a bet that we're headed toward a depression, and that is not happening. So that is a lot of what people are talking about right now, Jeff.
Devin, your colleague George Anders does something, I think it's bi-weekly, right? So it's every 2 weeks. And I think it's the workforce confidence, if I'm not mistaken. Is that correct?
That's right. That's right.
Is that this week or is that next week? It'd be interesting
we
to
have
see
our next edition coming out next week.
Okay.
But I will say, even in the most recent edition, we are seeing confidence trend upward across the board. I mean, I shouldn't say across the board. And in an aggregate basis, it's trending upward. Some industries, such as public affairs, education, are still quite down on confidence, but others are surging. And one of the ones we highlighted in our most recent edition was the real estate industry, which of course is impacted by a lot of factors and a lot of the deep underlying economy. So that's a good sign there. But there are those pockets like education, like public affairs and public administration that are still down a bit. But we have our next update coming out next week.
Okay, yeah, I'm really looking forward to hearing about that. And not trying to tell you what we want to talk about next week. I don't want to put that in, put words in our contributors' mouths, but I'm really interested to hear how that is tracking, given, we don't know what's going to happen next week. The bottom could fall out. I mean,
Yeah.
if we've learned anything, if I've learned anything, I can't speak for you. If I've learned anything, that to expect the unexpected and that no one really has a pulse on what's really
Yeah.
happening. I mean, it
Yeah.
just
No,
it
oh,
changes.
absolutely. Absolutely. And I would say that's why we're so focused on data here at LinkedIn, even more so in the past few months. We did have an interim report in between the workforce confidence indexes come out this week, part of our LinkedIn hiring rate analysis. And that actually showed some interesting dynamics between larger enterprises and small businesses. And what it showed is that small business, the decline in hiring among small businesses has really bottomed out, and now it's about flat, whereas larger companies are still, their hiring rate is still down quite a bit. And what we saw is some insights into the kind of nimble nature and flexibility of small businesses. They were able to cut hiring quite quickly in March and April, we saw, whereas the larger companies may have had commitments to new hires or to people who had signed but not yet joined. And so small business hiring fell more quickly at the start of this pandemic and downturn, but now has rebounded more quickly. And larger companies are still struggling with their hiring. So that was quite interesting. But yes, I'll give you a full briefing on that next week.
Yeah.
Although, related to small business news, which of course is such an engine of this economy, today, just actually about an hour ago from this recording, President Trump signed a bill extending the Paycheck Protection Program loans, which initially were covering 8 weeks of payroll, now covering 24 weeks for small businesses. It also reduces the burden, the amount that businesses had to spend on payroll for those loans to be forgiven. It was 75% they had to spend on payroll. Now it's 60%. Also a bunch of new guidance from the Treasury and the SBA that I would encourage, especially those listeners who are owners or operators of small businesses or work for small businesses to check out. So that was an important update this week.
Yeah, really. I mean, there's just so much going on. Last couple minutes, and obviously this deserves a lot more, Devin, but I wanted to get, we talked today on the program about what's happening domestically. I don't get into the politics of it, but what's happening domestically. I just wanted to get kind of the reaction. I know LinkedIn is a very forward-thinking organization. Just kind of, I saw Mr. Weiner, the CEO, write some things, but just kind of what maybe some of the discussions happening that you can possibly share internally, like maybe their town halls and things like that to help each other out through what is arguably a difficult time in the country.
Yeah, absolutely. And a lot of people are looking to certain companies and leaders as role models and for signals of how they, if they manage smaller organizations, should be approaching this crisis. So here at LinkedIn, we're north of 16,000 employees around the world. Our new CEO, actually, whose name is Ryan Roslansky, who
My bad.
No worries. It happened just on Monday.
Sorry, Ryan.
He published a great piece I would encourage people to check out with some insights into our global all-hands town hall this week. And some takeaways there. The one I would highlight is that a lot of companies are talking the talk, but need to walk the walk on this issue. And I think we're starting to see companies pressured not just to put out, so-called thoughts and prayer statements, but to really outline concrete, tangible steps that they will be taking to advance these issues and all societal issues. And so you're starting to see some of those notes coming out from CEOs now with specific dollar figures going toward different causes around this issue, specific numbers around reinvestment in their diversity and inclusion initiatives or diversity and inclusion councils, bulking those up, having them meet more frequently. And I think what the public and a lot of people on the platform are now calling for is, look, we need to see it in the numbers. Show me your org chart, show me your leadership, chart, and where's the diversity and inclusion there? So obviously it's a long road and takes a lot of time and thought and investment. But if this week shows us anything, it's that those improvements cannot come soon enough.
Yeah, Devin, and it's a good positive way to end our conversation. And I just want to point out that I hear the birds chirping, and again, I think you're almost like Snow White, in a way. You're like a Disney character. I don't know if you. I mean
I
that in a
just enjoy my backyard so much.
I know it's a very positive. I meant that in a very positive way. Devin Banerjee, it's always a pleasure chatting with you on the network, on the podcast. Very insightful. I'm just gonna like you right now. I'm gonna hit the like button. Great to talk with you. Have a great weekend, and we'll talk to you again next week.
Take care, Jeff.
Bye. Welcome back. Now we're going to shift gears, talk technology. On the line, Daniel Klein. He's a senior, or the senior, consumer products and technology reporter for the Motley Fool. Hey, Dan, how are you?
I'm good, Jeff. How are you?
Doing okay. It's been, good weather here. Obviously, a tumultuous week. A lot of things going on, but really glad to catch up with you and talk about what's going on in the news. And I know you wanted to talk about the Federal Communications Commission. I think they just had a ruling about ISPs.
Yeah, so they have delayed something called the Television Viewer Protection Act. Basically, this was a piece of federal legislation that stopped your ISP, your internet service provider, from billing you for equipment they didn't give you. Basically, you could use your own router, and they could charge you for that. Think of it like a corkage fee. Like you go to a restaurant that allows you to bring your own wine, and they charge you $15. But at least at the restaurant, they're bringing you glasses. They did have to get a corkscrew and open your bottle of wine, unless you didn't bring the nicest bottle, and they could just unscrew the top. But this is really a case of the overall goal of this bill is to simplify your ISP, your internet bill. So I don't know if you've ever looked at your bill, but it's not just one number. It's not like, I pay $49.99. Like that $49.99 number they tease you with is before taxes, before miscellaneous fees. It can vary based on where you live pretty dramatically because there might be a county fee, there might be a state fee, there's all sorts of and those fees aren't the ISP's fault, but they can charge you for equipment, they can charge you all sorts of surcharges and add-ons. So the goal of this is to eliminate that, and the FCC has basically pushed this out till December, and they're blaming the pandemic, as if somehow during a pandemic an ISP can't change its ridiculously bad billing procedures.
Well, I guess I don't understand. Why would you be charged for equipment you don't have, Dan? So if I go out and buy a router, and I like my router better for whatever reason, I don't want to borrow their router. Why would I pay a fee? It doesn't make any sense to me. It's not very consumer friendly.
It doesn't make any sense. Imagine though, if in your town there was only one restaurant, you were not allowed to go to any other restaurant, and when you get to the restaurant, they charge you an appetizer procurement fee because they had to get the appetizer whether you're going to order it or not. And that's kind of the situation. ISPs are monopolies in about 40% of the country. Mm-hmm. And in the other 60%, you have a choice between two. And there's no disruptor in this space. There's no T-Mobile coming in and being pro-consumer. So basically, these companies are all kind of in lockstep. And their goal was always to make as much money. Every year on the ACSI, the American Consumer Satisfaction Index survey,
wow,
the least popular companies are always ISPs, followed by cable companies. Those are, of course, all the same companies. So this is a business people don't like, and this is a very small step towards charging you for what you get and being transparent about it. But right now, they could basically say, okay, you don't want to use our equipment? We're going to charge you for using yours because it's on our network. And that makes no sense. It doesn't cost them any more money, but they're allowed to do that.
Dan, we've talked on the program a lot about 5G, and I know 5G is not available in a lot of areas, but does that do anything to change any of this? Because these ISPs are effectively the gateway into using the internet, and all of us use the internet, right? So they're just, in my opinion, it's kind of like, we've talked about the transition from, to cutting the cord with the cable companies, and that's clearly cable is going away in its current form in some way, shape, or form. So does that do anything? Does 5G do anything to kind of upend the ISP monopoly, as you put it?
So true 5G does. The current 5G, which is essentially 4G that's a little better, doesn't.
Okay.
So you're also going to need a wave of technology. Right now, there's only a handful of phones that can use true 5G. So 5G should give you effectively ISP quality speeds just through your phone network, just through your wireless network. The problem is they need devices to allow you to harness what you're paying for on your phone and probably charge you more to send it to your television. So, now obviously there's casting, there's ways to do that, but there's no sort of efficient way. You're not. We've seen it with people opting for a Roku instead of a Google Chromecast. People want the easiest way possible to be able to do this. So yeah, for the younger generation that's used to internet being something that they consume on their phone, that might not even hook into the Wi-Fi in their house, and they're just using the current 4G connection. I know my son does that all the time, and we have unlimited data on T-Mobile, so it doesn't matter. I think that generation might, when they start getting apartments and houses and whatnot, they might decide my phone's enough, my iPad's enough. I don't need an internet connection, and that will be truly disruptive. I will also say, as an investor, I would not touch a cable or internet company right now.
Yeah, it just doesn't doesn't seem like a smart business practice. I mean, anytime you're not pro-consumer, like you have to be. First of all, number one, we're going through some really difficult times in the country in terms of the pandemic and other issues, right? So there are people who are really feeling the pain financially. Why you wouldn't waive this fee to begin with, or do something? Because you've seen car insurance. You've seen other companies waive fees. I know retirement plan providers have waived fees. So Dan, it doesn't jive for me.
Yeah, so this is a case where it's possible to pivot. And I'll give one example of a major pivot. Microsoft, for many years, was a monopoly. I mean, there was Apple, but Apple was very expensive. It was very much just like the graphic designers, the video editors, schools, very limited use. So they could charge whatever they wanted for Office, for Windows. They basically had the whole computing market. And then Android came along, and Android took the tablet market, just absolutely took it over. So Microsoft had to make a pivot where they said, okay, we're now going to sell Office as a subscription, as an affordable subscription. Windows, in some cases, on Internet of Things devices is going to be free. Windows on Windows tablets is essentially going to be free for the OEM providers. And they pivoted their business model. Right now, if I was Charter Communications or Comcast or whoever, I would be calling up John Legere, recently stepped away from being the CEO of T-Mobile, and I would say, please God, come here and be our CEO, run our cable and internet business, and break it, and tell us, how do we make this consumer friendly? Because if you're one of these companies, Cox Communications, anybody that has either an ISP cable pure play, or a company like Comcast that has a massive part of its business, they need to pivot and become customer friendly now. And the only way they could do that is to hire an outsider who is famous for doing that and giving him the keys. Do I expect that to happen? Absolutely not. So these companies, which have built their whole business on not having to treat you well, they're going to get their comeuppance, and it's going to be enjoyable as a consumer.
So Dan, I was going to ask you the question. I think you already answered it, really. I was going to ask you the question: why don't companies? I'm just saying companies in general don't innovate. I mean, as an innovator myself, creating something, but you find that a lot of people are just kind of stuck in the tried and true. Is it fear of cannibalizing what you have and you don't have anything in the future? Fear of adaptation? Is it, what is it inherent in these organizations that doesn't allow them to adapt?
So I think it's laziness. I think every big company should have an internal group that's trying to create a disruptor.
Yeah.
Because you at least want to identify it. If the music industry saw streaming coming, if the newspaper industry saw the loss of classified ads, because that was really what doomed newspapers, was Craigslist, which took away. I mean, when I worked at the Boston Globe, there was an entire giant area of the building that we held concerts in. That used to be classifieds. So, hundreds of people and tens of millions of dollars, that was all self-generating.
Yeah. So
if I was one of these companies 10 years ago, I would have had a group saying, what are all the ways someone else can disrupt us? Instead, they said, wow, in 1982, we signed an exclusive contract with Swampscott, Massachusetts. That's where I grew up. And we're Time Warner Cable. We have exclusive rights for 10 years. And then in 10 years, when that's up, our ability to renew that is pretty high because we have a lot of infrastructure here, a lot of stuff people want. Oh, maybe we'll have to throw them a bone. Now there's a public access studio. It has 2 cameras and one guy who makes $14,000 a year. So basically these companies got very fat and lazy, and it takes a lot. Let's look at who's innovated. Walmart bought Jet.com so they could have access to Mark Lowry and his team, who were true disruptors. And then they went in and said, we are going to spend billions of dollars to disrupt our brick and mortar business because we believe omni-channel and digital are important. Target has done something similar. Very few companies do that. When you look at the so-called retail apocalypse, most of the companies that are struggling are ones that for the last decade have been saying, hey, I sell shoes at the mall. I sell clothes at the mall. That's a pretty good business. Nobody's going to disrupt that. Yeah, I would like to see just massive efforts to see where the threats are coming from and be those companies. Why was Macy's not selling subscription boxes 3 years before anybody thought of it? Why have grocery chains didn't figure out, meal kits and other things like that? They had all the ingredients to do it, but you need to be able to say, how am I going to disrupt my business? What could take us down?
Yeah, I think you make a good point. It's almost like what I would call like a SEAL team, an internal SEAL team, a cross-functional team that would be designed to kind of strip it down and rethink, re-engineer how things are done. Makes sense to me. Dan, always a pleasure talking with you. Looking forward to having you on the network early this week. And until then, have a great weekend, and we will talk to you again very soon.
Looking forward to it. I'll see you soon.
Thanks, bud. Bye-bye. Welcome back. Now we're going to shift gears, talk a little markets, and, lots going on this week. Joining me now to bring up this and a lot more is Mr. Kevin Kelly. He's the co-founder of Delphi Digital, and he is also a reformed equity strategist. Kevin, welcome back to the program this morning.
Thanks for having me, Jeff.
I was just kidding about the reformed equity strategist part. You're still an equity strategist. So, Kevin, we're recording this at 9 a.m. on Friday morning, and the jobs report just came out, and 2.5 million new jobs in May. You can't even say exceeding expectations, like well beyond expectations, well exceeding expectations. Give us your perspective.
Yeah, I mean, it's a great point. It went against expectations almost, right? Yeah. It's not even like the jobs number was less bad, I guess you could say, than what many economists were expecting. The consensus was around, between 7 and 9 million in terms of potential job losses. And what's really interesting, I mean, this 2.5 million that brings the unemployment rate back down to 13.3%, which is still obviously extremely high. But again, the economist forecast prefer 19%, a jump in unemployment to 19%, right? So again, just really going entirely the other direction. And so what I think is important though on especially days like this, and I've been scrolling through my Twitter feed, I'm sure as you have this morning, and even within the last half hour since it was released, you have a lot of initial kind of takes, people coming out and saying, giving their initial reactions to the headline numbers. And I would just caution that oftentimes the story is a bit deeper than the headline. So part of my day-to-day will be going through, exactly where, these job gains came from. I know some of it just from looking at some of the initial numbers was in construction and actually in, retail trade and things like that. But, it could, if this is not, a fluke type number, it could be an early indication that we are seeing a faster recovery than we expected. Now, the I won't say conspiracy side of me, but the other side of the argument potentially is that as you get to because as you get to the end of this initial kind of wave of PPP, one of the important implications of it was that by the end of June, if you brought back these employees that you had furloughed or let go, part of the loans that you've gotten from PPP could be forgiven if you're using those for, again, employment, rent, utilities, things of that nature. And so I think part of this potentially, I don't want to say it is, but it potentially could be a bit of companies kind of trying to play that game. I know I'd seen a couple of people again on Twitter, which is you take with a grain of salt, but a couple of people mentioning that they had personal experiences where they had been told that they'd been brought back, but we're going to be permanently let go as of June 30th. So again, don't want to try and badmouth the jobs number because it certainly exceeded everyone's expectations, obviously. But I do want to stress that the story usually is, a bit deeper than the headline numbers.
Yeah, I'm looking. Sorry, as you were chatting, I was also looking at the Dow Jones Industrial Average for the 5 days,
Yeah,
And
I've got futures pulled up too.
yeah, but I'm yeah. So I mean, this is the thing that I recall growing up as a child and watching Good Morning America with my folks as I was getting ready for school, and they would always report the Dow Jones Industrial Average. There are a lot more indices, especially that sophisticated financial professionals use. But when I look at this week in particular, because I was expecting after our conversation last week, Kevin, we had Hong Kong, right? Reclassification of Hong Kong. I thought that was really going to hit the market hard. I thought that was going to recalibrate things significantly. But then, looking at this week from June 1st to June 4th, because we're not yet into the market as we're chatting, we were at just below 2,500. Now we're sitting at 26.3, give or take, 26,300. It's just amazing. It just really goes against what people are saying. And I just have to ask a question, and I really value our financial professionals. I think there are a lot of smart people, but does anyone really have an inkling of what's going on? And I think, to me, just based on what I'm hearing people say, I don't think anyone really can really point their finger on the who and why things are doing what they're doing.
Yeah, I think it's a really good point because, again, financial professionals and ourselves included, right? I lump myself into
I'm in that
group.
I'm in that group. I'm in that group.
Right.
I don't know what's going on.
Exactly. And like being, an equity strategist, and now, obviously putting out research on crypto and Bitcoin. I mean, our job at the end of the day is to try and help people understand what's happening in markets, but also where we think they're going. And so I can say from personal experience, oftentimes it's easy to get caught up in kind of what consensus is saying, and there's so much information that's available today, right? Unless you have your own kind of proprietary ways in which you're looking at things, which we certainly, have developed or try to develop in-house. It's easy to get kind of caught off guard by some of this. Now, one of the things I will preface with is you have seen, obviously, a really substantial rebound within risk assets, specifically stocks. And as you mentioned, the Dow Jones up this morning, the S&P is up around 1.5%, which tacks on even more gains, right? So we're within striking distance back of getting the S&P back to its all-time high that we saw back in February. And I would say that you can make the argument that, stocks are leading indicators because they discount what the future expectations are, right? And so the rebound after that huge sell-off in the equity market could have been, I think, an early indication that things potentially could have been improving, but the strength of that rally, and at least initially, was much more kind of technical driven, or was what we call in the industry a bit of a relief rally, right? Where you see these huge sell-offs, this natural rebound, and then I put myself in the camp where I thought the risk was much more to the downside, just given how deep and prolonged, we still expect this global recession and tepid recovery to be. But, seeing these types of numbers, maybe things are turning around a bit faster. What I would caution, though, is that, again, going back to our conversation, I think we had either last week or a few weeks ago, the world in which the pre-COVID world that we were in wasn't necessarily this kind of golden era of growth, right? So I think what's important to note is a lot of the problems that we were you just mentioned, Hong Kong last week, and obviously the China trade war is now coming back into kind of the spotlight. There's a lot of issues or structural headwinds to the equity market going forward once we do get through this. And so it's not like a V-shaped recovery would solve all of our problems. Anyway, we had a number of different headwinds heading into this entire outbreak of COVID and the kind of aftermath of it. And so, again, not trying to be, fear-mongering or anything like that, but I do think it is important to note that there are still a lot of headwinds that we're going to face and need to address, debt being a huge issue, once we get through this and out of this. So, again, good day for the equity market, great week for the equity markets, people out there who are making money and seeing their retirement savings increase. Obviously that's great, and we want people to be able to build wealth in that sense. But again, just really kind of take some of these numbers and these kind of intra-week fluctuations with a bit of a grain of salt.
Yeah, Kevin, how do you bake into the analysis what's been going on in the United States over the last week and a half? A lot of turmoil domestically, outside of the market. I'm not necessarily talking about the politics. That's another separate issue, but there's certainly people who are not feeling the economic. We covered it today on the program with Devin Banerjee, your former colleague at Bloomberg and now at LinkedIn, that certain groups of the population have been more impacted by the coronavirus and the pandemic. They're economically not advantaged, they're disadvantaged. How does that get baked in? How does all this domestic tumult for lack of a better term, get baked into the market?
Yeah, great. It's a great question. So I think you bring up a really good point because in this, again, if we fast forward and try and think about what this post-COVID world is going to look like, right, when we get through all this, one of the big things and trends that I think will accelerate is this concept of widening wealth and income inequality. And so if you think about who's been hit or most affected by this, to your point, it's been on the lower end of the income scale. And so the people who usually have the wealth and the assets are the ones who didn't have to dip into their savings, for example, during this, right? They were well off before then, and now with markets rebounding and getting back close to all-time highs in risk assets, that wealth has continued to stabilize a bit. Whereas on the lower income scale, obviously you've seen wealth start to get eroded. And where that really has potential long-term effects on economic growth and, again, this post-COVID recovery world is when you think about what you call the marginal propensity to consume, which is basically just how much if you're making $100, how much of that are you going to save versus how much you're going to consume. On the lower income scale, that marginal propensity to consume is much higher, right? People spend a much larger share of their income on consumption, and that contributes to the economy and contributes to GDP and economic growth. Whereas, the wealthier people or rich people tend to save more of that incremental income. And so when you get out of this world, that marginal propensity to consume, at least in my opinion, I expect to come down because even if you go back to the same income levels, people are going to have to repair impaired balance sheets, shore up savings, things like that, right? So I think this entire event, and that's why we think the recovery is going to be much more tepid than some people expect, is because when you look at who makes up, the backbone of the economy and who's going to be the ones that are going to consume and bring consumption back, it is in that lower income scale, right, which obviously has been adversely affected or disproportionately affected, I should say, throughout all this.
Yeah, this is something that I think is the larger, broader issue, is how to get people equal opportunity, and we need to talk about that in order to do what you're describing. Kevin, I want to shift gears now because we have you and you can wear two hats, and our friend Oliver Rennick is taking some time off from his town hall in St. John's to relax. But I want to talk about crypto now. You were on the network yesterday talking about the impact of the pandemic on crypto and things kind of. I think you mentioned that there was they were very correlated for like a week, and then now things are uncorrelated. But give us your assessment now of crypto now that we've had this week and how things have transpired over the full week.
Yeah, I would say, crypto by and large is still pretty tethered to how, I think risk appetite is perceived across different markets, right? So again, jobs number today, you don't want to say, these aren't really global macro type assets yet, right? You're not expecting to see huge fluctuations or minute by minute jumps based on, the incoming economic data like you would expect in the equity markets or the fixed income markets or foreign currencies. But what I will say is, this rebound kind of in risk assets, I think certainly continues to be put a bit of support underneath the broader crypto space because, again, it's a little bit riskier. People are starting to kind of maybe take some of that wealth and rebalance it into some of the riskier asset classes or alternative asset classes like crypto. Bitcoin itself, I think, is in a really interesting position because, obviously, there's a number of different potential headwinds or arguments you could make for Bitcoin falling from these current levels, which is right around 9,700 as of now. But I think longer term, if you put into perspective what's happened with the monetary and fiscal policy, if things continue to worsen, then you would expect larger kind of monetary and fiscal stimulus packages to come in, which long term, certainly puts a bid under a scarce asset like Bitcoin. On the flip side, what these jobs number and people are already speculating on is, let's say this is a trend and this recovery starts to accelerate, faster than people expected. Well, does that mean that the Fed and the Treasury are actually going to kind of step back, right? Policymakers will step back from the amount of stimulus that they've been pumping into the system, and what does that mean for risk assets, and what does that mean for potentially a digital gold narrative for something like Bitcoin? And so what I think is interesting is long term. Both of those worlds potentially could be beneficial for Bitcoin, because even if we do start to see a faster recovery, we're still going to be awash in a lot of this monetary and fiscal stimulus that, we've seen an explosion in the Fed's balance sheet, money supply, and things like this that we need to deal with on the other end of this, right? The global debt to GDP levels I was talking about have continued to skyrocket throughout this. And it's not just in the US, it's in Europe, it's in Asian countries, it's in a lot of emerging markets. So these debt levels, I think, have just accelerated the potential timeline for the narrative of something like Bitcoin to catch on. And so I don't want to say that all roads lead to, Bitcoin and gold and precious metals, but in this world of fiat abundance, I mean, the digital scarcity narrative that can be applied beyond Bitcoin, but Bitcoin certainly being the kind of most prominent in that space, I think only strengthens, in the aftermath of all this.
Yeah, well, it certainly has been a surprising and challenging week in so many ways for the country. Kevin, I want to thank you so much for breaking it down for us. Have a great, safe weekend, and look forward to connecting with you again next week. Take care.
You too, Jeff. Appreciate it. Have a good one.
Welcome back, and now we've got a very special guest. We're going to talk about collective investment trusts, a very specified investment vehicle. And joining me on the line is Devin McCarthy. He's a managing director with NASDAQ Fund Network. Devin, how are you today?
Doing well. Good morning. Thanks for having me, Jeff.
It's great to have you on the program. Let's jump right in, because I think a lot of our audience may not be aware of exactly what a collective investment trust is. We've talked about it on the program before, but just for context, why don't you start there? Give us just a basic definition of what these vehicles are.
Yeah, absolutely. So a collective investment trust, Jeff, is a pooled investment vehicle only for qualified retirement plans. Mm-hmm. So these are they can be similar to mutual funds, but these are only for qualified retirement plans.
Right. So these are basically unitized version. When we're talking about a trust, participants in a retirement plan, so a plan sponsor, an employer would add this to their 401k, their governmental 457, and it would kind of mirror in a way a standing mutual fund. So you have a traditional mutual fund, and instead of buying shares of a mutual fund, you're buying shares of a trust. And Devin, I guess the benefit of going into a collective investment trust is that by pooling, especially if you're a smaller plan, you can realize some cost efficiencies.
Yeah, that's exactly right. And I think, one of the biggest kind of, forces right now in the defined contribution space is, really that fee pressure. I think the entire financial services space is kind of is feeling that, and it's absolutely in the defined contribution space as well too. So, this race to the bottom, if you will, really that's where a collective investment trust can have benefits over, other pooled investment vehicles such as ETFs and mutual funds, mm-hmm. because of the lower fees with the CIT. So we're finding that that segment is really growing, Jeff, among the smaller to medium size retirement plans.
Sure.
And so that's really where we see kind of the growth, and others are seeing that growth in that space as well too.
Yeah, and Devin, we talk about this. I mean, traditionally, if you think back to when I was a younger person, got into this business, a lot of people we didn't have as much internet access as we do today, and so people got their quotes, their net asset values, which is the daily price from the newspaper, right? They got it from the Wall Street Journal. Yep. They may have gone online to Yahoo, but it wasn't regularly sourced. And there was some challenges when it came to collective investment trusts because this wasn't typically published and the information wasn't always publicly available. I know you and the team at NASDAQ have kind of taken a step in that direction in terms of more transparency. You want to talk a little bit about what y'all are doing in that regard?
Yeah, absolutely. So to your point, those mutual fund NAV prices were always kind of, scarce and hard to find. And the NASDAQ Fund Network was really built to be able to provide transparency for mutual funds a couple of decades ago. And we put mutual funds on the map, we feel, insofar as, be able to register a mutual fund, mm-hmm. Assign that ticker to the mutual fund and then disseminate that information out to all the major platforms today where you can do mutual fund research. And so we are literally doing the exact same thing here in 2020 with the collective investment trust space. We're working with trust companies and asset managers to register the CIT on the NASDAQ Fund Network. And then, Jeff, we're providing a 6-character searchable ticker to that CIT, and then allowing that to then be disseminated out to all the platforms that we connect into. So that's Bloomberg, FactSet, Refinitiv, many different open public-facing websites as well too. So now those CIT tickers are now transparent, similar to mutual funds. And today we've got 360 CITs registered on our platform.
And that's really important. So when you are vetting a particular investment, you want to understand beyond just the prospectus, right? Because everyone probably doesn't read the prospectus, but they may read the mission. And a lot of times the naming conventions are not always in alignment with the mission. And that's a whole nother issue that we can probably tackle on a different day. But that transparency, really important for investors, consumers, end users, but also employers and consultants and advisors, right, who are vetting these investment products for these qualified plans.
That's exactly right. Yeah, I mean, I think one of the most significant developments here is for the first time ever, a plan participant who has a CIT in their defined contribution plan, 401k plan, can now look up that CIT just like they would be able to, a mutual fund or a stock or anything like that. And to your point, the consultants, plan sponsors, they can do, preliminary due diligence by, researching, the price and price history of these CITs on, open websites and on other institutional market data platforms.
Now, Devin, so we've been talking about these CITs in a broad context and talking about what they are. And a lot of people who are in 401ks or in governmental 457B plans probably would have seen a CIT. But there's one section of code section of the Internal Revenue Code, section 403B, that does not allow currently CITs. And right now, you are limited in a 403B to only mutual funds and certain insurance-based products like a fixed annuity. Is there any development there that you can speak about in terms of maybe being able to offer some parity to these 403B plan participants who are also looking for cost efficiencies? It doesn't, in my mind, having been in the space for nearly over 2 decades, doesn't make a lot of sense.
I think that we would agree with you there as well too, Jeff. The 403B space is an exciting space that is currently there's currently right now some bipartisan legislation being proposed to allow CITs to be included into 403B plans, and this is absolutely a space that we're excited about, and we want to see what the developments are over the course of the next several months. But yeah, I agree completely with you that these 403B plans should be able to allow CITs in them. And I think that this will be another segment of the market that CITs are going to be able to grow into. And we as the NASDAQ Fund Network want to be there to, be able to create that immediate transparency for those plan sponsors of the 403B plans and the plan participants as well, too.
Yeah, let's hope. Obviously, there's a ton going on right now. We had the passage of the Secure Act, then we had the pandemic, we had the CARES Act, a lot of focus on that. We've got some other issues here in the United States that we're dealing with as we're chatting about this. Maybe this isn't a complete focus, but back in 2008, 2009, we had some new rules around 403B plans, and it just seems to me that really created for the first time this framework like we have in the 401k and governmental 457 world around fiduciary responsibility, and that includes managing fees, managing investments, and making sure everything is done prudently on behalf of the end user, the participant. It just seems natural to me that this is an extension of that. Here we are 12, 11 years later. Hopefully they can advance this and move this forward.
Yeah, I would completely agree with you. And I mean, I think, the overall kind of mission statement, not just of the NASDAQ Fund Network, but, NASDAQ as a company is really is to be able to provide transparency to all levels of the financial services spectrum. So to your point, 403B plans, that is a focus of ours, and anything we can do to help move that along, I know that we would be keen to do that. So that's definitely a space that we're watching.
And you mentioned you've got over 300 CITs on your platform, and I have to think that when you look at the marketplace, and I talk to investment managers all the time. I know you do as well. You talk to record keepers. More and more asset management firms and insurance companies and record keepers are looking to create CITs because they are gaining momentum. Do you have an idea of? Well, first I was going to ask you how do you intend to kind of grow this list? Because I can't believe that there's just 300. There must be many more than that. And how do you intend to grow this data source over time?
It's a great question. It's a great question. Our understanding is, there's well over 7,000 collectives out there among, especially when you start, thinking about all the different share classes that are out there as well too. So we've been at this now for the last 9 months. We have 4 different trust companies on the platform. Wilmington Trust was the inaugural partner of ours that launched over 200 in the beginning. In August of last year. We've got Comerica, Alta Trust, and most recently Hand Benefit and Trust Company, a BPOS company that registered 31 CITs with us earlier this week. So our goal, we've got a very big pipeline for the rest of the year. We're working with all of the major players and, ensuring that we, get the value prop out there. And once you're able to illustrate to an asset manager and or a trust company and show them, bring up on a Bloomberg terminal, what this CIT looks like and really can validate that investment with that ticker, it really makes a lot of sense to kind of all levels at the asset management level and the trust company level. Yeah. That's how we intend to grow this. We've got a big pipeline. I'm expecting an additional 1,000 registrations the rest of 2020. So got a lot of work ahead of us.
Yeah, apparently. We're nearly through the end of the year, so you're going to have to through the middle of the year, excuse me. You're going to have to get on your horse, but certainly know that you guys are doing a great work, and that transparency is so important, really a fundamental part of monitoring your defined contribution and actually your defined benefit, all asset pools when you're managing them on behalf of other people. Well, Devin, we're going to have to leave it there. Thank you so much for joining us in the program this morning. Really appreciate the lesson on CITs, and look forward to having you back on the program very soon.
It was a privilege to be on, Jeff. Thanks for having me. Have a great weekend.
Thanks, Devin. Enjoy the rest of your. Hopefully, I did a good job. And
no, that was great. Listen, this is great. This is exactly what I would need to push this, kind of up the chain and everything like that. Yeah, I don't think that I could have. Even in a wish list, I wouldn't have been able to imagine having something like that. So no, that was huge. I really appreciate it.
Yeah, I will send it. So we post this on Sunday. It's called BRN Sunday. I'm recording the show actually today with about 6 other people. So you'll be in there, and I'll send it to you, and we can chat next week.
Awesome. Are you okay with me posting this to mine as well too?
Yeah, I'll send you a link.
Okay.
I'll send you a link in the. I'll tag you, and I'll send you a link, and then you all can, and NASDAQ can post it if they want. That'd be great if NASDAQ can post it.
I'm gonna see if they can be able to post it as well too. So no, this was really helpful, and this is a perfect way for me to be able to showcase kind of the power of your reach and your platform and everything. So really appreciate you hit the ball out of the park with this. Thank you.
All right, man. Thanks, and have a great weekend. Stay safe. We'll talk to you soon.
All the best. Take care. Bye-bye, Jeff.
Welcome back. Now time to talk about real estate. On the line, Jacob Passy. He is the real estate reporter with Dow Jones Market Watch. Hi, Jacob. How are you?
I'm doing well. How are you?
I'm doing okay. And I know you kind of changed locations. I think you relocated a little bit to Maine for a little bit of a break. How's the weather up there?
It's nice. It's Maine summers are kind of all over the place. Right now it's still pretty cool out, although it's in the 70s today. But it gets warmer as the summer progresses. But it's nice. It's a very comfortable temperature right now.
Good. I'm glad to hear it. Hope you guys are getting some relaxation in and escaping the, hot town summer in the city, that kind of thing. It's getting hot here in New York. So let's jump right in. I know you had some thoughts about real estate tied into current events. So what did you write about this week?
Yeah, so I did a story looking at, what the housing market looks like for Black Americans, because, and this is a subject I've written about before, but, my whole team, we're looking at different issues of, financial lives for people of color this week in light of, the protests over the killing of George Floyd and the broader Black Lives Matter movement, and trying to put into context, some of the other grievances that people of color in this country, specifically Black Americans, have. And certainly, the housing market is, a major source of concern for Black Americans. Even to this day, it remains very unequal. Black Americans have less access to mortgage financing because of the requirements, partially because of the requirements lenders put in place in terms of credit scores and things like that. But there was even an investigation that came out this week from a local news affiliate in Chicago that found that, mortgage lending is almost exclusively concentrated in the white neighborhoods in Chicago. Black neighborhoods get very little in the way of mortgage funds, and kind of shows, those issues. So also putting, kind of a current spin on things, there were a number of reports that came out that kind of painted how the current pandemic is going to disproportionately affect housing for Black Americans and people of color. Because of the job losses that have been going on as a result of the economic shutdowns that took place in recent months, most of those job losses were concentrated in the service sector. A lot of those were jobs that require less education, are lower paid, and for all those reasons, and because of reasons of so-called occupational segregation, which is a fancy way of basically saying that it is harder for people of color to get access to higher paying jobs that require more education in this country. Black Americans have disproportionately been laid off or furloughed compared to white Americans. The job numbers came out today, and while the headline number showed unemployment improving across the U.S., for Black Americans, the unemployment rate actually ticked up slightly, and it also rose for Asian Americans, and it fell for Latinos, Hispanic Americans, but it still remains at 17%. So those groups are being affected much more. Those demographics are being affected much more by the economic effects of the pandemic. So what that means for housing is, if they have lost access to income, then it's going to be harder to pay the rent. There were surveys that went out this week from the Census Bureau that showed, about 1 in 4 people of color, 1 in 4 Black Americans said that they were unable to pay the rent in May or deferred their rent in May, which was much higher than the percentage of white Americans that said the same. And a significant share, almost half of people of color basically said that they are unsure about whether they will be able to pay rent in June. So when you think of that, you think of folks, potentially becoming homeless, potentially being evicted, and these are issues that aren't being solved by the economic stimulus payments and expanded unemployment assistance right now.
Wow. I mean, obviously, this is a important topic. There's a lot going on, obviously, domestically or here in this country. I mean, do you? It's so early, right? I mean, it's not really early, but I mean, it's early. We're talking about this. It's a week and a half into this event, right? But do you have any ideas, or have you heard anything about solutions to resolving this and making it more equitable for everybody to buy a home or everyone to be in the right situation?
Yeah. So I know that advocates have also expressed concern about some of the rollbacks of regulations that went into effect over, many years. There's been rollbacks in terms of from the Trump administration and other agencies, rollbacks of requirements as far as, tracking data surrounding lending, changes to, Community Reinvestment Act, which required lending activity to occur in neighborhoods predominantly populated by people of color. So some of those changes, advocates say, could hurt Black Americans, Latino Americans, Indigenous Americans, because if we're not tracking this data, if we're not requiring, the Community Reinvestment Act changes that were floated suggested that other sorts of activities in these communities could count towards a bank's, banks basically are required to, by law, to, do a certain amount of activity in neighborhoods that have traditionally been, excluded from the banking system. And so there's been an effort to broaden what qualifies for that requirement. And for people of color, that could mean, though, if the things banks can do become broader, it actually means that they might, see less in the way of, mortgage lending, things like that. Mm-hmm. So those are changes that, advocates have been calling on, rolling back some of the changes that have been ushered in recent years. There's, also, kind of the Biden administration earlier this year floated a proposal, or not the Biden administration, Biden campaign, floated a proposal to change to increase regulation of the appraisal industry, because, a persistent issue in this country is the legacy of redlining. So, in the, around the New Deal era, for those who don't know what redlining actually refers to, basically there were maps put out that, assessed the risk of neighborhoods across the country, supposedly, but what they really were doing was basically highlighting communities that were predominantly populated by people of color, by Black Americans, by Asian Americans, by Hispanic Americans. And so if your neighborhood was redlined, that was a signal to banks and insurers that supposedly it was riskier to do business there. And so those companies avoided doing business there. What that effectively meant was that Black Americans, many Asian Americans, just didn't have access to, home insurance, to mortgages, et cetera. So what that has done is, in the 1960s, those rules were, those policies were outlawed. There are cases here and there where you still see that happening, like I mentioned with the Chicago example. There's certainly still modern day contemporary cases of what would have once been called redlining still occurring. But setting that aside, even where it's not necessarily occurring anymore, home prices in neighborhoods that were once redlined are still much lower than in neighborhoods that have historically been populated by white Americans. And so that's had a major effect on the racial wealth gap, because in the U.S., one of the main ways people accrue wealth in their life is by owning property. And that's also how wealth is passed down from generation to generation. And so, in a lot of these neighborhoods that were once redlined, home prices are still lower. The same home in what was once redlined as a Black neighborhood will cost less or be valued at less than a home in what was historically a white neighborhood. Mm. And so that, that creates issues of, the generational, that contributes to the generational wealth gap for, people of color versus white Americans. It also has led to the gentrification boom, which, a lot of folks are advocating for, policies to be put in place to support Black homeowners in gentrifying neighborhoods, because, as neighborhoods gentrify, tax assessment rates and things like that will go up. Because the home values in those neighborhoods will go up. And so if this is a home that was handed down in, a Black family for generations, the current generation may not be able to afford the higher tax rate and could lose their home as a result. And so these are, and then you kind of get into the issues there of losing that, passing on of wealth from generation to generation if they lose their home. So lots of issues that, policy changes. So the Biden administration has called for the appraisal industry to be, more heavily, regulated, so that they are, appropriately, appraising properties to take into account these kind of historical factors that have, disadvantaged Black communities and other communities of color.
Yeah, obviously there's a lot of work to be done here. I guess that's a big understatement. There's a lot to be done, not just socially, but also when it comes to the regulatory environment. Jacob, let's hope that we can move the needle a little bit over the next couple days, weeks, months, years to make things better for everyone. Jacob Passy, always a pleasure chatting with you. Really insightful information. Thanks for bringing it to us. And enjoy your time in Maine. Enjoy that weather.
Thank you.
Take care. Bye-bye.
All right. Take care.
Welcome back. We're talking healthcare now. On the line, she is the senior healthcare correspondent for Business Insider, Lydia Ramsey. Hi, Lydia. How are you?
I'm good. How are you?
I'm doing well, and I should have added that you are also the editor of Dispensed, a healthcare-focused newsletter that you can find on the Business Insider website and also on LinkedIn. People can subscribe, right?
Yes.
Okay. So lots going on, obviously, with the coronavirus. We've got these horrific events, the protests, a lot of tumult here domestically. What's going on in your neck of the woods in healthcare?
Yeah, for sure. I think this week has been, pretty interesting for a number of reasons. I don't think there was a world in which we expected the pandemic to not be the most major news item in the U.S. At this point in the pandemic. But one of the things I'm keeping an eye out on as a healthcare reporter is the research that's underway to find treatments and vaccines for the novel coronavirus. So this week we saw some really great data coming out. And also some controversial data around the antimalarial medication hydroxychloroquine. So this week, on Wednesday, the University of Minnesota published some of its results around hydroxychloroquine's use preventatively, and found that it didn't benefit people who had been exposed, in pretty close proximity to someone who'd been diagnosed with the novel coronavirus. So that was really helpful to see. That was the first kind of really high quality data we saw coming out about this particular medication. If you remember, this is the one that Trump's been talking about a lot. It's one that got a lot of hype in the early days as a potential treatment or even a preventative treatment. Trump said that he was on it at one point. So it was really helpful to get those results. But on the other side of the coin, what's been really interesting is a couple of weeks back, we got a massive study came out that was published in the journal Lancet, which is one of, probably one of the top medical journals out there. And it kind of talked through, and showed that patients who were hospitalized who had taken hydroxychloroquine with or without an antibiotic didn't seem to have a benefit compared to those who didn't get it. But later, scientists really raised a lot of questions because, this data set that they used was really massive. It was 96,000 patients, kind of 6 continents, a large data set, but only had a small group of authors on it, which raised a lot of questions about the company that, I guess, compiled the data. It's a company called Surcharges. And anyway, as people kept poking into it and trying to get a better sense of what the data looked like at the really granular raw data level, they learned that they couldn't get access to the original data. The company wouldn't allow them to. And so because of that, the study authors on this trial and then one other trial that used Surcharges data asked them to retract the studies. So now that data is, that study is completely taken down. It's pretty dramatic to see it go from such an influential study. The World Health Organization called off one of its legitimate trials around hydroxychloroquine because of it. They put it back in place after kind of these questions were raised, but it's really remarkable to see all the back and forth and all the drama going on as we try to navigate and get to a place where we have good information and evidence about these treatments.
Yeah, I think it's really interesting because I think last time we chatted, which was 2 weeks ago, it had just been the news of the potential for a vaccine. There were some drug trials, and I think you had remarked that this is really amazing how quickly public-private partnerships can develop a vaccine, or private companies can develop a vaccine that's really unheard of. But aren't these kind of the growing pains that you would expect? I think people are really rushing to find a solution. I mean, I can't underscore that enough, that people are really putting in the effort to try to find a solution. I think, they have the best interest at heart doing it. And with that being said, there's going to be some failures along the way. And normally, Lydia, and I guess this is where your expertise comes in, you would have this over these trial and errors, you would have over a longer period of time. Now it's compressed, and obviously with such a high-profile event, although it's been knocked off the pages of the headlines this week for obvious reasons, things have been truncated, and therefore it's really kind of bubbling up, and maybe that's the reason why this is happening.
Yeah, for sure. And I think it's one of those things where I think we're in this now. We're in June. It's been a few months since this really hit the U.S. I think we have a little bit more of a luxury of time to really be thoughtful and really think through things in a way that we probably didn't in those first couple of days. Mm-hmm. But as I think through the development of treatments, especially new things like the vaccines, it's going to be really important to really, really thoughtfully and really thoroughly evaluate the safety of them. Everything, nobody wants kind of a slapdash vaccine that, might ultimately hurt people or might not do what they want it to do in long term. So really getting that data, it will take some time, but I'm keeping my eye out and keeping it seems that everyone's been doing this pretty accountably, but to your point, we've had a couple instances like this where data has leaked or data has come out that isn't quite up to snuff, and it's one of those things where I think the scientific community is learning a lot about how do we be swift and fast and reactive while also being accurate.
Yeah.
It's just a different speed completely.
It is. It's admirable, though, that people are really rushing to do this. Just real quick, I mean, obviously there's a lot going on in the country. Just wondering about, one thing that was talked about before these domestic tumult was happening, that is happening today, was the possible resurgence of the virus, the second wave, I think they were calling it, and maybe the fall. Is there any movement along with that? Any thoughts? I mean, we've seen a lot of protesters and people, and what I can see, people have their faces covered, but I don't think they're practicing social distancing. I mean, is there a little bit more immediate concern now that this is happening, that we could see a second wave earlier? I realize that many of these folks are younger, so they necessarily wouldn't be directly impacted, but they could infect other people. So I'm just wondering if maybe that has changed some of the complexion of that conversation.
Yeah, absolutely. I mean, I think a lot of estimates and things are really accounting for, and projections really account for, maintaining social distancing. But, one of the things I'm thinking a lot about is we're seeing numbers start to go up, case counts go up in states that have been slowly reopening. Obviously, that's part of the calculus for reopening, right? Like, you're going to assume some risk if you open up restaurants. And it's just the level of risk you're willing to take and how do you do that appropriately. But we are starting to see that already. And I do think that, give it a couple more weeks, but we might see, an increase based on, kind of the proximity of the protests and things like that. It'd be great if we didn't. I'd be really curious to see, but I think it's important to keep that in mind. What I'm keeping an eye out for are the states that are reopening, what kind of this widespread effect of loosening restrictions are having on the wave. There was a report out today from Morgan Stanley that was concerned that we might have this second wave a lot sooner than we might have otherwise, based on kind of our inability to keep the virus at bay at a rate that other countries have been managed to do so, in Europe and in other places around the country or the world. So it's something we'll be definitely keeping a really close eye on. Yeah,
you're definitely seeing, I think people are just feeling bottled up. I mean, I can't speak for everyone, obviously, but I think people are feeling bottled up. And you look at that, there is, I think Memorial Day, there was that in Missouri, there was that Memorial Day party, and I think one or two of those folks actually had the virus. So, I think it's like when people are going out, this is my own personal view, that they're kind of doing that risk assessment and saying, is it worth the risk? And I think, for some it is, and for others are saying, look, I don't want to go to a restaurant. I'd rather cook my lentil soup here, and I'd rather do things here in my own apartment or a house until things kind of get, they're taking a more conservative approach. So I think it'll be really interesting to see. I'm really anxious to see future newsletters about future episodes of Dispensed and learn what y'all are covering. Lydia, it's always a pleasure talking to you. Thanks so much for making time out of your incredibly busy schedule. Safe travels, and we'll talk to you again soon.
All right, thanks so much.
Bye. Welcome back. And now we're on to retirement. Joining us on the line, she is from Dow Jones Market Watch, where she is a retirement reporter, or the retirement reporter, Ms. Alessandra Melito. Hi, Ali. How are you doing today?
I'm good. How are you?
I'm doing great. Thank you, all things considered. It's been a tough and challenging week in a lot of different ways, as many people know. But I'm glad that we could chat. I always enjoy our talks, and you were great on the network this week on Wednesday. So kudos to you. But I want to check in because a lot's transpired this week. What's top of mind for you and your colleagues at MW this week?
Yeah, so I had looked at a study that talked about the post-pandemic effects on the retirement industry. Just overall, where we stood before COVID and where we might, where we may stand after COVID. As you know, and as everybody knows, there is a lot of uncertainty right now around, just what will happen in the next couple of weeks or months around coronavirus, especially because there's no vaccine that's been distributed yet, and there are a lot of changes happening, such as reopening, and there have been protests, so we don't know the impact of that yet. So there are a lot of unknowns at the moment about just the status of Americans in COVID, or even globally in COVID.
Mm-hmm.
But these researchers had looked at just potential impacts on the retirement industry regarding COVID. So as we know now, a lot of times, or in most cases, people get health insurance from employers, and that's something that may change after COVID. You might see health insurance and pension plans become disassociated from employers, so that people aren't quite at risk of losing these plans or losing healthcare coverage because they no longer are employed by that particular employer. It could also help in regards to saving. Pensions are wonderful. Of course, a lot of companies don't have pensions anymore, but if they did, oftentimes people rely on that for their retirement security. And if they get cut off or something changes in the pension plan because the employers cannot fund it anymore, or even worse, if it goes bankrupt or something like that, that becomes a huge, huge issue for retirees. So that might be one effect, just like a disassociation for healthcare coverage and pension.
Mm-hmm. Wow.
Separately, we may see just changes in financial decision making. So consumers may benefit by having better data around financial products and the pricing of those products, regardless if they're an investment or an annuity or something like that, just because it would help people plan better, because this pandemic was a perfect example of expect the unexpected. Mm-hmm. A lot of people did not see this coming, even though, of course, in the past people had talked we're going to see a pandemic in the future. Even I was watching Shark Tank, an episode from a couple years ago, and one of the presenters even talked about it. He's like, yeah, we're due for a pandemic soon, and that was 3 years ago. So people have talked about it, but nobody really sees it coming, and people have lost jobs. They have had to enter retirement sooner than expected because maybe they were already in that weird position where they were probably going to have to transition soon, and this kind of pushed them over the edge. Having better transparency around products and just having a stronger sense of financial literacy would help in the event of an unexpected situation such as this. So that is something that we may see. In all of this, though, the researcher makes it very clear in her study that we have no idea when or if these things would happen and in what capacity, because as it stands, officials really just don't know what's going on. Or they might have an idea, but no certainty around the future,
Mm-hmm.
And in the meantime, we will see people suffering from COVID and its impact on the economy in the sense of lost jobs and lost investments. Granted, there's a lot of market volatility. Sometimes that means the market goes up, as we have seen recently. But we're on this like wild economic roller coaster right now, and we have no idea when we're going to get off of it. So we just have to wait, essentially.
Yeah, I mean, I think you're right, and I think what's really concerning me, Allie, and I think it's a great piece. I saw your piece, and obviously a great amount of research that's very informative, especially for policymakers. The thing I worry about is the impact to those, women and minorities, especially, who already were challenged to save. We could see that really explode and expand well beyond where it is today, and it wasn't even great where it is today. So I think we share that concern. I think that's an area for policymakers to think about. And I think you're right, because we're not going to know. No one has an inkling. First of all, no one. We're talking Friday afternoon, and no one even got remotely close to the jobs numbers, right, that were released earlier today, which were very positive. Everyone thought it was going to be the other way, and no one really has a sense for where the markets are going to go. And that being said, no one has a sense for where this virus is going to go. So all that uncertainty is going to play into the American savings rate, all the other things that you discussed.
Yeah, the coronavirus has impacted pretty much everybody, no matter if you're a high earner, low earner. But it does obviously affect some people more. So like people of color and women are, as we saw in a lot of the statistics just on the health side, they're more likely to suffer from coronavirus and more likely to get sick and unfortunately worse. And also just like the little aspects here and there. So like the little details, it's not just unemployment, but it's unemployment for those particular groups. And it's not just people having to leave the workforce because of sickness. It's people who are acting as caregivers to those who are sick. And, that's, for example, oftentimes it's disproportionately women, for example. So it's while everybody is being affected, it is touching on literally everything, from retirement savings to just the fact that people become unemployed and therefore may struggle paying for the day-to-day things. And it affects the health of all different ages, not just the elderly, even if they are more likely to suffer. And it affects housing, because if you can't pay for housing, then that's an issue entirely. And it affects child care, family caregiving. I mean, we're seeing this virus literally touch every aspect of society, and even down to the protests, because some officials talk about like the impact of protesting in COVID and spreads and stuff like that. It's just, there's so much we don't know, and that can be really overwhelming sometimes. But this particular research, at least, it did explain some of the potentially good things that could come out of it. Obviously does not outweigh the bad, but just that in all of this uncertainty, it's important to take care of yourself. It's important to stay safe, and it's important to look at how we can kind of rebuild.
Yeah, rebuild so that there's parity for everyone. Allie, always a pleasure chatting with you. Really insightful pieces this week, and wishing you a very safe and great weekend. Get some relaxation and drink some coffee, and we'll talk to you again next week.
All right, sounds good.
Take care. Bye-bye. Welcome back. Now we're going to talk with our legal friends, the Legal Eagles. They are retirement rock stars. David Levine, Kevin Walsh, both are principals with Groom Law Group. Gentlemen, how are you this week?
We are wonderful, Jeff. We hope you and everybody else is safe and well. It's good to be here. And I will say, just as a preview for Kevin, I feel like we're on a roller coaster right now, because it seems like every week we get something new from DOL. Like we had these dry periods, and it seems like right now everything's moving. In fact, even this morning, the PEP RFI seems to be leaving DOL, leaving the Office of Management and Budget. But guess what? That's not this week's topic. What do you think we should talk about, Kevin?
I mean, David, I think we should say for next week the PEP RFI, because we'll know what it says by next week. So my thought for this week is we talk about this week's news, which is Wednesday morning, the Department of Labor released an information letter that provides insight for plan fiduciaries when they're considering the use of private equity inside a target date fund or other similar vehicle. And this is pretty significant because plans have typically used target date funds as the default option. And target date funds have typically been made up of, long only stocks and bonds. And that's been kind of the main way for the last kind of since the Pension Protection Act that, your average American has been able to save for retirement. When you look at how defined benefit plans invest, how foundations invest, how endowments invest, and by that, I could summarize it as what really big and sophisticated investors do when they invest. And those big sophisticated investors, they use more asset classes than that. They use things like private equity. They use things like hedge funds. They use things like business development companies, interval funds, non-listed REITs, a whole world of products out there.
Wait, Kevin, couldn't you have just said portfolio diversifying investments and made it easy?
I probably could have.
I know, it sounds better the way he delivered it, though, David. I'm just kidding. Sorry, go ahead, Kevin.
But, this week, the Department of Labor offered kind of thoughts for plan fiduciaries if they want to design targeted funds that include an allocation to private equity. And essentially, they're saying, plan fiduciaries, if you want to consider private equity as a component of your target date funds, it can be prudent to do so. And you're like, well, wow, I mean, where's the news in that? ERISA's never said, you can't use certain asset classes. But the real significance here is that in recent years, kind of innovation in the defined contribution space has been chilled somewhat by, real litigation fear. And you can see it because you've got this Intel case where Intel designed a target date fund that includes an allocation to portfolio diversifying alternatives.
Good one, Kevin.
and they've been sued on the allegation that, the fees were slightly higher, and by adding a complicated investment, the plan participants said they didn't understand the option. And so it's helpful that in light of kind of that litigation pressure, the Labor Department is reminding plan fiduciaries that what matters is fees are important in terms of evaluating things. Fees are a component of your analysis. But what matters really is that you pick investment options that are designed to maximize the chance that your participants have good outcomes. So it's fees count, but don't focus solely on fees at the expense of outcomes. And also it's helpful because it reminds plan fiduciaries that they're there to make the tough decisions in terms of figuring out what options should be offered. And that it's not really a free pass saying, my participants aren't sophisticated enough to understand this product, so I'm going to give them lesser options. Plan fiduciaries should be considering products and evaluating them in light of kind of their ability to understand the products. David, do you want to highlight other aspects of the letter, or have I managed to eat up all of your time?
Kevin, I know that was payback, but I want to diversify your comments a little bit here, and go from there. Let me try to boil it down.
Are you going to boil the ocean?
Yeah, well, no. You boil the ocean with that presentation. Let me try it this way. I think you did a great job. I concur. I think the very simple takeaway, it highlights the fact, I think, is what you got to at the end, that realistically, there's all this talk about cost, fees. Fees is not the only thing that makes a prudent fiduciary. And in terms of process, there's a lot of things. I want to talk about looking forward, though, for a minute. Because as we look forward, this is a great step forward, because as you look at alternative asset classes to put inside defined contribution plans, which are used in DB plans, it's good. The next step from here is a lot of questions. How do you build, and I know Kevin and you and I talk about this all the time, we're working with people on this. How do you figure out how to use these products? How does this relate to the SEC? I know Kevin and I have talked to the SEC. There's one of the discussions about maybe the SEC will hopefully make this more flexible. Chairman Clayton seems to be in support from the press release that was issued. What's the products that will be done? How do fiduciaries get more comfortable with this? How do their intermediaries, like their consultants? And really documenting this, because yes, we have the litigation, and finding ways to buttress the arguments, no matter if you use this or any other structure as you go forward. There's one last thing I'm going to add, Jeff, and then I know we've burned our time. Kevin was very sort of matter of fact about it, but we're always happy when our firm, we've been involved with a bunch of the trade groups doing this, Kevin and I, and other colleagues of ours actually worked on on the actual letter. So it's a near and dear topic to our heart. Just like for all of you who listen in every week, missing participants is Kevin's favorite topic. But on that note, let's go missing and not go any further.
Well, gentlemen, go ahead, Kev.
So David, you summarized what I said. So why don't I summarize what you said? I mean, it seems like, you complained that I went too long-winded, and then you spent 4 minutes summarizing my 4 minutes.
That's so not true. So not true.
To really sum it up, I think DOL has begun to signal a shift from a fees mindset to an outcomes mindset. And it's nice to see because that opens the door to more asset classes.
You know what, Kevin? I'm gonna recap you for a moment then to get the last word. They've gone from cost to more than cost. Try naming that tune in less than those words.
Gentlemen, always a pleasure talking to you. Fascinating topic. Obviously, more to come on this. Really groundbreaking. And gentlemen, I can't say anything more but to say have a great weekend, and we will talk to you again next week.
Jeff, thanks for having us on. And if I could say one word at the end, I'd just say modernization.
Touche, my friend.
Bye, all. Take care. And that's a wrap for this week's episode of the BRN Sunday podcast. I want to thank Devin McCarthy for his appearance on the program this morning, making time. I want to thank all of our contributors, and of course, I want to thank you, our audience, for joining us each and every week. Don't forget, we're back again tomorrow morning on BRN AM. I'm going to be joined by Paula Fargo. She's the president of Curry Printing. We're going to be talking about PPP. That's right, the Paycheck Protection Program. You're not going to want to miss it. So until then, I'm Jeff Snyder. Stay safe, keep saving, and don't forget, roll with the changes.